Hey, howdy folks, welcome to yet another edition of Smarter Money Matters. It really does, with your wealth doctor Jeff Camarda, joined by our super CFPs, Lou Versil and Anna Wunderlich. Thank you so much for watching with an important, this will be short, but really, really important for some of you, podcast on a recent development from the big, beautiful bill, recent tax legislation that's particularly valuable to seniors, and I bet you haven't heard about the additional free deduction for seniors we're going to tell you all about. From the Wall Street Journal, seniors act now to squeeze the most from a big new tax break. And Lou, I don't know about you, or Adam, did you know about this? I didn't know about this before reading the paper.
Only actually knew about it this week because the CFP board did a webinar on the One Big Beautiful Bill. So It's kind of fresh on the mind, but before that, I hadn't heard anything about it.
Well, bless their gold little hearts. So this is the senior tax break, gives them how much? $6,000? A $6,000 deduction in addition to your itemized or standard deductions, right?
Either or, it doesn't matter if you itemize or use the standard.
You still get the $6,000, right? So if you're in a 30% bracket, you'll save another couple $1,000 almost in taxes. Mm-hmm. It's meaningful, so be aware of it. However, like most of the provisions in tax arithmetic, it is subject to some limitations. In this case, I think it's mostly adjusted gross income. Is that right, Lou?
Well, they have to be over 65 years old, and,
right.
adjusted.
So they got to actually be a senior.
They have to be 65. Yes.
And
it's phased out towards, so there's, it goes to, according to the article, for individuals, it's up to $75,000 in income and $150,000 for joint filers.
So the phase out begins. So if a couple has $150,000 in AGI, they get the whole $6,000,
Yes.
right? It completely phases out above $175,000. For singles and $250,000. For a married couple, so that's between $150,000 and $250,000, you get some but not the total benefit.
Correct.
And depending on how the math works, you'd have to look. The way they usually do this, if you're splitting the difference, if you're $200,000 in AGI, you'll get $3,000 instead of $6,000. It's usually proportionate, haircut. So it's available to all eligible taxpayers, regardless of whether they itemize or take the standard deduction. But you're going to want to do a pro forma probably with your tax preparer. I know most of you don't have tax strategists, unfortunately, but try to get some feeling for it, and if you're seeing this in 2025, to maximize the value of the benefit is applicable this year, I think, isn't it?
Yes.
Right, to squeeze yourself into that AGI box, try to get it over, under $150,000 so you get the maximum benefit. And what are some ways that you can do this?
Well, it's especially, I think, for people that are taking money from their investment accounts like IRAs and taxable accounts, have a little bit more flexibility as opposed to people that have guaranteed pensions, because you can kind of control how much money you take in a year. So if you're close to that cusp, you can maybe reduce your monthly payment a little bit to get, if it makes sense, to get underneath the threshold, so you get the full benefit.
And then this is really kind of a special case of what we do with Roth estimates and Rothalizers. Do you have something you want to share before I get into those weeds?
I was going to say, if somebody's still working, right, if they're over 65 and still working, maybe try and tuck extra income at the end of the year into their retirement plan if they still have space through work. That's a good way, a pre-tax contribution if they had a little bit of room they needed to get under the limit.
Sure. And when we talk about for Roth conversions, the essence of which is maximizing the amount of conversion at the cheapest possible tax price, it's really the same exercise. You want to look at what your income is and target $150,000 in this, problem of adjusted gross income, and what variables do you have? What things can you change? Can you shovel more money into a tax deductible 401k plan or something like that? Can you pull less retirement money, non-RMD money, less retirement money to reduce your income that way? Can you increase business deductions? Can you accelerate depreciation on real estate if you're a real estate investor? There's a lot of factors that go into crafting a tax strategy year by year, and to the extent that you're able to suppress your adjusted gross income, you increase the value of this tax deduction, right? That's pretty much the essence in so much of tax strategy. And they're suggesting portfolio, maybe not recognizing capital gains tax, right, would be another thing that you could do. Any other charitable gifting, which I know you were looking up earlier, is also one that can really move the needle in terms of donor-advised accounts or outright charitable distributions, which were a really big hammer in reducing taxable income. But the one caveat that I really hope that you guys, everybody listening, internalizes is that remember, with charitable contributions, you're always winding up with less wealth in your family. If you give away $100,000 and get a $100,000 deduction, and you're in a 40% tax bracket, just for simple numbers, you're saving $40,000. But the 100's still gone, so you net out $60,000. Don't ever lose sight of that effect. You have to actually do the math and see what it cost you. There's some tax advantages, sure, but it's still a net cost. So you want to do that only if you're genuinely charitably inclined and you actually want to help the charity, which is great. Don't get me wrong, but you have to appreciate that it's a gee whiz, I can do good and make money. You don't make money, you lose money. Any final thoughts?
So when my wife says it's a write-off, I shouldn't believe her. When she says it's a write-off and she buys something nice for herself, it's a
watch
write-off.
out she doesn't write you off. Any final comments?
$6,000 per person. So if you're a married couple, both above 65, $12,000 deduction.
Great point. Yeah. How do I sign up? Guys, help me suppress my income, please. Oh, wait a second. What am I saying? And on that happy note, folks, we wish you all a very profitable week. Thank you so much for watching with Lou and Anna, and of course me, Jeff Camarda. All the best. See you next time.